Happy Friday, friends. It's Shayan with Integrity Home Mortgage, back with your weekly rates rundown for November 14th, 2025. This has been a fairly volatile week in rates markets, although we have been able to just barely hold on to the range we established since that last week jobs report we received in early September. The biggest headline of the week, of course, being the end of the longest government shutdown in history at 43 days. 10-year Treasury yields currently sitting right around 4.14%, which is 5 basis points higher than they were a week ago. Mortgage rates slightly weaker still at about 9.5 basis points higher. I've talked ad nauseum at this point about the potential impacts of the shutdown, and despite the fact that it has now ended, that still remains a question. I mentioned last week, CBO estimates that each 30 days of a shutdown results in about a 1% drop in GDP, which means that this shutdown would have caused a little over a 1.4% reduction in GDP. It's, of course, said that much of that will be recovered as people get back to work and paychecks start coming in because of the guaranteed back pay. It's really just a matter of timing and not about total compensation. But if you believe, major institutions like PNC Bank, Market Watch, Lending Club, somewhere between 60 and 65% of Americans live paycheck to paycheck. So the timing bit can't be underplayed. It could be every bit as important as total compensation. How much deeper did those 60 to 65% of folks have to go in terms of debt uh, to survive the past 43 days? What will that do to their ability to service their overall debt and their probability of defaulting on some of that debt in the future? And speaking of timing, Black Friday, which is obviously the biggest consumer spending day of the year, is just 2 weeks away, and how much of that recovery will have happened by then? Of course, only time will tell, and I'm not out here necessarily sounding any alarm bells, just highlighting the fact that these are the types of things that credit markets, including mortgage investors, see as the potential sources of increased risk going forward and could continue to drive underperformance in mortgage rates, much like we saw this week. The good news is that we should start seeing data start to flow in again very soon. The September jobs report was just a couple days away from being released when the shutdown went into effect. So that one should be pretty easy. But it will take some time to crank the machine back up before we get the rest. I haven't seen an update on exactly when newer data, specifically on jobs and inflation, will officially be released, but I hope for the sake of properly functioning markets that we will be communicated those details pretty soon. As it does come out, keep in mind that hawkish data, as I've mentioned in the past, hawkish data, which means stronger jobs, higher inflation, means that rates will rise. Dovish data, weaker jobs, lower inflation, means that rates should fall. The next meeting of the Fed is less than a month away, and probabilities of another rate cut in December are now at less than 50%, which is down from the mid 60s a week ago. That's primarily due to cautious comments from Fed members over the course of the week, reminding us that, hey guys, inflation is still a problem. There's a better chance of a cut in January, but that's going to be highly dependent on how the data ends up coming in. My bottom line this week, rates have continued to weaken a bit, but remain within a few basis points of the best levels we've seen in about a year. Volatility will continue to be a major theme in rates markets for the foreseeable future. And that's likely to accelerate as data starts to flow in. So now is not the best time to be sitting on locks. Protect yourself, protect your borrowers, lock them early, lock them often. And that's all I got for this week. We'll see you guys next time.